So here's the thing. I've been, educating traders for over the last 6-7 years, and what I've realized is that there are many traders who are actually making one of these 3 mistakes. And the worst part is these mistakes, right, are actually being taught in textbook courses, shared on forums, and many traders just don't realize, right, that this is actually costing them a lot in the long run. So in today's video, I want to share with you what are these 3 mistakes and how you can actually avoid it. Okay, but first, right, do me a favor, okay? Hit the thumbs up button and subscribe to my YouTube channel so you don't ever miss a trading video from me. Have you done it? Okay, just below, hit the thumbs up, subscribe. And with that said, right, let's begin. So, the first mistake is that you set your stop loss at market structure. What do I mean by this? So let me explain. So, you've been taught, right, maybe from textbooks, on forum where, trader says that, when you go long, right, you should always, put your stop loss, below support, right, below support here, below support, okay? Or if you are short, right, you should put your stop loss above this resistance over here. And the problem with this is that, let's say, right, the market is in a range and it's over here. If the market, there is a lot of, let's say, orders above this high, so right, let's say a lot of traders, they are short, okay? So when they put their stop loss, they put it just above resistance. So over here, there is a lot of buy stop orders above. A lot of buy stop orders. Okay, so what happens is that the smart money, what they'll do is that they'll push the price higher. So let's say the price is over here, they'll push the price higher, triggering this cluster of buy stop orders. So when they push the price higher, this means that they have to go long at this price, so they have to buy, and they push the price higher. Okay, so what happens is that when the price hits this cluster of stop orders, this is going to fuel further buying pressure, because when the traders who are short, the price hits their stop loss, right? This is actually buy stop orders in the market, so it fuels further buying pressure. And what would a smart money at this point do? Well, they'll start to take profits, right? They start to take profits at this particular area over here where the buy stop orders are, where traders put their stop loss, right? So this buy stop orders is triggered, the smart money, and then look to take their profit. So this would kind of like neutralize the effect. So this is why the price, often you see, it comes into this area of resistance and then boom, smashes lower back into the range. Okay, this is a very common phenomenon, right? And even similar, if the price is around this level over here, if there is a lot of sell stop orders over here below support, traders who are long, they put their stop loss just below support, right? Over here would attract, right, a large cluster of sell stop orders. So as the price comes lower, right, the smart money, they'll go short around here, push the price lower, okay, hitting this cluster of stop loss, right, thereby neutralizing the effect again. So for example, the sell stop order from traders who are long will push the price lower. The smart money who is short, right, will look to buy back their position, neutralize the effect, right? And what happens is that, again, the market then reverse back up higher. So this is a very common phenomenon. And let me share with you, right, a few examples on the chart. So you can see over here, this is one example. Notice the price, again, this is an obvious market structure. Price comes in, spike through above this highs, reverse lower, right? Another one over here. Market structure here, so traders tell you, put your stop loss, right, below swing low, below support. Price comes in, spikes through lower, reverse higher. Okay, can you see what I'm trying to share over here? Again, here, swing high, market structure, price comes in, sweeps above this highs, reverse lower. So this is a very common phenomenon in the market, and this is why I say don't put your stop loss, right, at obvious market structure. This means, right, you don't want to be putting your stop loss just below support or just above resistance. Instead, what you want to do is give it some buffer. Okay, so if you notice that, this is the highs, right, give it some buffer, like, like 1 ATR somewhere about here, so you don't get, spiked out when the market just take out the highs and then reverse lower. So give it some buffer, right? So this is the buffer that you can give it, right? If you want to have a more definite example, right, use the ATR indicator, right, average true range, find out what is the value. So let's say, for example, the value at this point in time, right, is about, let's say, 60 pips. So from this high, you add on an additional 60 pips. So that is the buffer that you can use to kind of give yourself a more wider stop loss so you don't get stopped out on a spike up or spike down. Okay, so this is important. Okay, don't set your stop loss at obvious market structure. Number 2, a mistake that traders make, right, is that they like to chase breakouts. So what do I mean by this is that they see the price, right, like say for example over here, then it breaks out over here, they start buying at this highs, right? Because again, textbook might say, you want to confirm the breakout, wait for it to close above resistance, and then you go long, or wait for it to close below support and then you go short. And the problem with this is let me share with you what I mean. Okay, over here. Okay, just let me get rid of the ATR indicator. So you can see that over here, yep, right, we have a breakdown at this point in time, right? Textbook would say, price breaks below support, close below it, go short. And the problem with this is that if you were to go short right now, where are you going to put your stop loss? Well, logically thinking, right, if you want to, use it based on market structure, you would have to reference your stop loss, right? Nearest is from this high over here. And you can see that your stop loss is very wide, right? This is so wide, your stop loss. And the thing about chasing breakouts is that the market, right, has a good tendency is that it would mean revert. Okay, so this means, right, that usually after the market has made a huge move, right, the price will tend to retrace back towards the mean. So in this case, you can see that it starts to retrace. In fact, this is actually the bottom before it breaks out higher. So you want to be careful about chasing breakouts. Usually when the price has, go up consecutively many days in a row, it's usually, right, one of the worst times to be buying breakouts. So now you might be wondering, okay, Rayner, so how do I trade breakouts? Okay, I'm glad you asked, because this is what I want to talk about right now. Okay, so let me look at this this particular market that has a good example. So if you look at this, right, whenever I trade breakouts, I want to be trading breakouts with a build up. So what is a build up? So unlike the earlier example where you are trading breakouts, a build up refers to a tight consolidation prior to the breakout, like this, a tight consolidation prior to the breakout. You might be thinking, Rayner, why do you want to have a tight consolidation? Two things. Number one, you can actually reference this tight consolidation to set a proper stop loss. So now, instead of setting your stop loss below this swing low, you can reference it from this low over here. This gives you a tighter stop loss, right, and improves your risk to reward on the trade. The second reason is, whenever you see a build-up form at the highs, right, it's telling you that there is buyers willing to buy at these higher prices. Because if you think about this, right, if the price is at resistance and is holding at resistance for quite a long time, what does it tell you? Well, you know that resistance is a level that there is potential selling pressure to push price lower. So this is why it's, often you see price comes into resistance and then reverse lower. But what if the price comes into resistance and it holds there and holds there and holds there? It probably means that there is someone somewhere out there who is willing to buy at this higher prices. So this is why you have this consolidation, hovering at resistance. And it's something like this over here. This is what I call a build up. And this to me is a sign of strength. So now, when the price, let's say it breaks out above this build up, you can actually reference this low to set your stop loss. Now your stop loss is much tighter and you have a higher probability of the trade actually working out in your favor. In this case, right, obviously I cherry pick this example and the price, break out higher. So this is another possible setup. Again, you have a very weak pullback, somewhat looking like a bull flag. Again, if you want to buy the breakout at this highs, you can reference this low and set your stop loss. Compared to the earlier example where, you saw the palladium one, this is disgusting, right? Imagine you're going short over here, setting your stop loss, right, 1 ATR above this highs. Can you see the difference in just the size of the stop loss that you're dealing with? It's a lot of difference, and that would have a huge implication, right, on your potential risk to reward on the trade. Because, right, if you think about this, right, if your stop loss like this, right, it's a lot larger, for you to earn 1R on the trade, you need the market to move this distance, right, to earn the amount of risk that you risk. Let's say, for example, you risk $500 on the trade. This means that the market now have to move this much distance for you to make $500 on the trade. Whereas, let's say, in trading breakouts with a build up, let's say your stop loss is only this distance. Every time the market moves from here to here, you make $500. So the distance required is much lesser. Okay, so this is why with a tighter stop loss, you improve your risk to reward on the trade. The market don't have to move a lot, right, for you to make 1R, 2R, or 3R. So this is the second thing that I want to share with you, right? Don't chase breakouts, right? Always wait for a build up to form before, trading breakouts. And finally, the third thing is that a lot of traders, they micromanage their trades. So what do I mean by micromanage your trades? So let me explain. So, okay, just get this. So you can see over here, okay, this is not the one. I was looking for the other one. Okay, so you can see over here, let's say, right, this is another case of, price breaking out of a build up, right, breaking above this highs over here. So hey, maybe you might go long, maybe you went long on the break of this highs, okay, and that is all well and good. And what happens is that you start to micromanage your trade. You start to go down to a lower time frame and see what the price action is doing. So let's say, for example, this is a daily time frame trade, and then you go down to the 1 hour time frame, okay, and you see something like this. Okay, so this is the breakout level. Okay, the breakout level. And then you notice that on the lower time frame, the market starts to show signs of crack. Okay, notice that over here, you have a series of lower high and lower low. And the market finally, did break below this prior swing low. And you tell yourself, oh man, price action says that, this market is going lower, right? It's a lower high, lower low. Market is at a downtrend. Let me exit my trade. Okay, this is something that you probably would think, right? Maybe not this time frame, but this is the thought process that you might be having. And the problem with such an approach is that you are micromanaging your trades, because if you enter on the daily time frame, you are supposed to be managing your trades on a daily time frame, not on the lower time frame. Why is that? Because the lower time frame is noise to your trading. Okay, so as you can see over here, let's say on this lower time frame, this 1 hour time frame, it might seem that the trend is reversing towards the downside. But when you look at the daily time frame, what you'll see is that this is actually just a pullback on the daily time frame, right? And because you micromanage your trades on the lower time frame, you basically miss the entire move higher. Okay, so what is the lesson over here? The lesson over here is very simple. If you enter off the daily time frame, you want to manage your trades on the daily time frame minimum, right? You can go up one time frame higher. That is fine if if you're an advanced trader, you know what you're doing. But the bare minimum is that if you enter on a daily time frame, manage your trades on a daily time frame. Because if you manage your trades on a lower time frame, okay, in this case, right, a pullback on the daily time frame will look like a downtrend on the lower time frame, and you will scare yourself out of the trade, right? Because you are micromanaging your trade. You're trading the noise on the lower time frame. Okay, so this is important. So don't micromanage your trade. That's number 3. So let's do a quick recap, right, to what you've learned today, right? The 3 big mistakes, right, that traders make and how you can avoid it. Number 1, don't set your stop loss, right, at market structure. As I've explained earlier, right, if you just put it below support, right, the smart money can push the price down lower, triggering the stop loss, right, and then, swing it back up higher. And then, right, you might get the direction right, but you're not in the trade because you got stopped out, right? So what you want to do is give your trade some buffer. Number 2, don't chase breakouts, right? Firstly, right, when you're chasing breakouts, more often than not, the markets are usually about to reverse because the market doesn't go up in one straight line. It usually goes up, retraces, and then continues to move up higher. By chasing breakouts, right, you are putting yourself in a very unfavorable position. Number 1, your stop loss is very wide. Number 2, right, the market is likely to do a pullback or even a reversal, and you're pretty much, buying near the high. So that is not favorable. Instead, if you want to trade breakouts, look to trade breakouts with build up, as what I've shared with you earlier. Looking for tight consolidations on the chart. And number 3, don't micromanage your trades, right? If you're entering off the 1 hour time frame, manage your trades on the 1 hour time frame. If you're trading off the 4 hour time frame, manage your trades on the 4 hour time frame, and etc. Okay, don't enter on a daily time frame and then manage your trades on a 5 minutes time frame. It doesn't make sense at all, right? It's ridiculous if you ask me. Okay, so these are the 3 lessons, right, or mistakes that I want to share with you today, and I hope that you can, or we all can learn from it, right, and you don't make them in future. Okay, so with that said, I've come towards the end of this video. If you want to learn more about my trading strategies, my methodology, heard that, right? Go down to my website, tradingwithrayner.com over here. Scroll down a little bit depending what you want to learn. If you want to learn about trend following, download this guide over here, the Ultimate Trend Following Guide, where you'll learn how to profit in bull and bear markets. Or if you want to learn about price action trading, market structure, right? Candlestick patterns. This guide over here, the Ultimate Guide to Price Action Trading, just click this orange button and I'll send it to your inbox for free. Okay, so with that said, I have come towards the end of this video. If you've enjoyed it, hit the thumbs up button, alright, and subscribe to my YouTube channel. Any feedback or comment, just let me know below and I'll get back to you. So with that said, I'll talk to you soon.